Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Alrighty, welcome to the Smart Investing Show. I'm your host, Chase Wilsey, for today, and with me we have a special guest. Normally only joins us for a small segment, but today Harrison's with me for the full show. Brent is out of town, and Harrison, again, is our certified financial planner at Wilsey Asset Management. But we got a full slate of topics that we're going to dive into today. We're going to talk about investors have a false sense of safety in the stock market. Also, IPOs have looked quite exciting, but we still think don't touch them. And then we'll hit on the real estate market. And I know Harrison's topic today is insurance versus investments. And then companies we're going to take a closer look at. Well, that includes brokerage giant Compass, PACCAR. There was some big news in terms of tariffs. Seems like we're seeing tariffs every single day in the market. And lastly, Amazon agreed to a $2.5 billion fine. We'll look at the fundamentals for those three stocks, giving you an idea if we think it's a buy, sell, or hold. Harrison, how are we doing today?
Doing great. It's been a couple months since I was on the full show with you, but excited to be here as always.
Well, we got a full show, as you said, to kind of dive into. So let's get into it. As I said, we're going to start with investors have a false sense of safety in the stock market. Now, I was reading this article actually from the Wall Street Journal, and this is where a lot of the information came from. And it just was so pertinent to where we're at today. And there's a psychologist by the name of Gerald Wilde, and I believe he actually has passed away here pretty recently, but he came up with the term homeostatic years ago. And I believe it just totally fits where we are. It essentially means that when the environment comes to feel safer, and the key word is not is safer, but it feels safer, people's behavior becomes riskier. And I think that's so similar to what we're seeing in the stock market today.
Yeah, I mean, it's definitely a psychologist would come up with that way of thinking, but it's basically saying as things go up, people think that that'll just continue. So they're okay taking on higher levels of risk, maybe only buying a small number of stocks as opposed to a more diversified pile of stocks, maybe being more comfortable with leverage, maybe be more comfortable with, whatever it is. They're like, oh, well, this will just, we're creatures of habit, and we're conditioned maybe to think that things will just kind of continue as they have been, maybe from a short time perspective. So the last couple of years, things have been pretty easy. Well, maybe I can make a little bit more because it'll, maybe it'll just continue.
Yeah. And, sometimes I think for people looking at the stock market as an example isn't the best example. It's not as relatable. And, he being a psychologist didn't come up with this term for stocks necessarily. He used another great example to kind of put this in retrospect here. But he said that, when people are looking at driving, well, they'll probably drive faster in a big SUV than a little tin can of a car. Going faster in a big car does not reduce your risk of getting in an accident, but people feel safer. And that is where, again, you can look at the stock market. It's like you go up every single day, and you might be doing risky things right now, and you're almost getting this confirmation bias that, well, Wilsey Asset Management says I'm taking a lot of risk, but they don't know what they're talking about. I'm up 100% this year. Okay, congrats. You're up 100%. But what happens next? And you have this confirmation bias that you believe things are safe because you've done well. That can be a very, very dangerous path to go down because things can turn quickly, and all of a sudden those returns dissipate. And I loved your point too about, well, a 10% gain, maybe a 15% gain. It doesn't become good enough. If you've achieved those, you think you can get better. And now you're looking for a 20% gain, 25% gain.
It's there. Why not take it? Yeah, I'll just, what's done well, I'll just keep buying it. And, but I mean, I think deep down, all of us know that you shouldn't be able to make 50% a year. If you're doing that year after year, that cannot be consistent. And if it was, with compounding, it doesn't take very much time to accumulate massive amounts of money.
Yeah, and I think it's, you say deep down we should all know that, but I think there's some that don't. I think,
I'm telling you right now, 50% a year is not normal. 20% a year is not normal.
15% a year
Yeah.
long term.
Long term. I mean, the
Not
S&P
normal.
long term is like 10%, and that's looking at it right now after this huge bull run that it's had. I mean, it's at highs. So, through the ups and downs, an 8 to 10% return is normal. That doesn't mean that happens every single year. It almost never happens in a singular year. It's either up 15, 20. We've seen 30, 40% returns in a single year. On the broader market, we've seen down 10, 20, 30, 40% in a single year. So it's never like 8 to 10% usually, but on average 8 to 10%. So what that means is the more years you have of higher and higher returns, that's not consistent. At least long term, that's not been what's happened.
Like we looked at a stock last week, and I forget which one it was, but if you look at the 10-year return, I'm going to say it was up like 110% or something, but the 5-year return was flat. So you had a great 5-year period, and the next 5 years was very lackluster. And you have to understand that's how returns work. You can have a great 10-year analyzed return rate, but it could all come in a very small subset of years. And if you weren't in it during that small subset of years, your returns, your personal investment returns, could be terrible. And this whole concept of risk that people are taking, I we keep talking about it. We keep looking at these numbers, and I just worry that so many people don't realize the amount of risk that they're taking with their investments because of this, again, homeostatic concept.
And the opposite of that is true as well. Right now, things have seemed easy, so people are taking on larger amount of risk without understanding that that's a larger amount of risk. But that's why the opposite side of the spectrum is when there is a lot of volatility in the market, when things are down, that's when annuity sales are at their largest, because people are so afraid that now they go to something that's deemed safe. Annuities are terrible investments. I hate them.
We'll talk more about that.
But that's what I mean. When we go through periods of volatility, people gravitate toward those annuities because they're safe. So they perceive a larger amount of risk in those times, so then they're not comfortable taking any risk at all, which I don't really like to think of the stock market as risky. I like to think of it as volatile, so it goes up and down in the short term, but long term,
it can be very risky if you do risky things.
Yes.
With it, but if you're investing properly, it's
if you're
volatile.
investing, well, risk is the chance that you will lose money over, I would say, a long period of time. And you can't tell me that over the long term the stock market is risky, because it's literally every single time it's gone down, it's come back, because it's at an all-time high right now. So it can be volatile, and there are things in the market that are risky that potentially would go down because they're overvalued and they're not worth what they're trading at. So those go down. But a good diversified portfolio, at that 8, 10, maybe 12% on average per year, that's a sustainable, I would say it really has no risk, but it can be volatile.
Yeah. And when you look at the market today, we've talked a lot about different things that we view as risk. We've talked about the margin. I mean, that scares the heck out of me. One other thing is the zero-dated options. I mean, that is just pure gambling on the stock market. We talk about these AI stocks, these tech stocks, the valuations on so many of them. That is risk. But there was another stat that I just saw recently where I'm like, gosh, you just keep finding these private investments. If I didn't mention that already, that's another thing that worries me. But what I saw was there's been 672 launches of new exchange-traded funds so far this year. And according to this firm, FactSet, which is a financial analytics firm, it said 28% are tied to a single stock and 25% are leveraged. And I was going to say I loved this, but I'm going to say this scares me. And at least 3 seek to double the daily gains or losses of our favorite item, cryptocurrencies. I mean, these are not ETFs that, when you tell somebody you're taking an ETF strategy, many times they're like, oh, I'm taking low risks and I want to invest in ETFs and get a broad pool of investments. I have my own qualms with that argument, but now you're taking this where these ETFs are not safe at all. These are pure risk gambling instruments that I would say at the end of the day, and it's just another area of the market where leverage is kind of sneaking its way in. And leverage, as I've talked about many times, can be so detrimental in the long term. All of a sudden that leverage tilts over, things just fall apart. And there's so many areas of leverage that you don't realize in the market, and it just scares the heck out of me.
Well, I think of 600, I mean, I didn't know that ETFs were being created that often. 672, that's a ton. But
there's more ETFs now, I believe. I'm going off memory here. There's more ETFs than stocks now in the...
What?
Yeah.
How?
Because they keep creating all these different things.
I mean, there's like thousands of cryptocurrencies out there, I guess. But with 672 launches this year, if 28% are tied to a single stock, that's like 190. 190 ETFs this year that are just tied to one stock. So, and then 25%, so like 170-ish, are leverage. So even if you're not borrowing money yourself, these funds are borrowing money, and that's an extra degree of actual risk there. But I just think those numbers are so insane. 190, 170 new ETFs that have that immense risk to it. We talk about the stock market long term not having the right risk, but that stuff is extremely risky. That's pure risk.
That's
right.
pure gambling. And I was going to say one thing. I want to move on here to the next thing, but I had a conversation with a gentleman this past week, and people who listen to the show know we are not advocates of cryptocurrency. I think it is one of the most dangerous investments out there at this point in time. It's nothing. I'm going to put that out there. There's nothing. People that talk about it can't explain it fundamentally as a reason why you should buy it. But I was talking to this gentleman, and I'm like, I don't like crypto. And he said he wasn't investing in crypto, but he was trying to explain to me why crypto was valuable. And he used the example of saying it's like a sport trading card. And I'm like, well, number one, that's a terrible investment. I'm not going to buy a sport trading card. Number two, how does that relate to crypto at all? But when you look at it, it's like, I'd rather buy a sport trading card because at least that has emotional value. Like, I grew up watching LaDainian Tomlinson. I'm like, I would pay more for a LaDainian Tomlinson trading card than I would a one share of Bitcoin or one Bitcoin,
Well, Bitcoin's what, $100,000 right now? So you wouldn't.
All else equal.
You're going to buy a trading card for $200,000?
Let me see. I think there's more value to me in a trading card of LaDainian Tomlinson.
Your version of intrinsic value of those two things are different, right?
But what I'm looking at is just, I have never met a single person in these cryptocurrencies that can explain to me the fundamental reason to invest in them. And I think that is just so dangerous. And then to tie it back into these ETFs, there's so many now that are leveraged ETFs on these cryptocurrencies. I'm like, there's going to be people that literally lose everything on these. I mean, there's so much risk in them. And you just got to be careful.
Well, the great thing about investing is there are so many things that you can invest in. You don't have to invest in things that you don't like or you don't understand. You find something you do like and you do understand and that has a very high degree of success. That's the thing that you want to be investing in. That also has a high long-term rate of return.
Yeah, exactly. I mean, it's investing when you fundamentally break it down is not overly complicated. But people, again, get too cute with it. They gamble with it, and that's where the risk ensues. Speaking of risky, one other thing, too, to talk about is IPOs have kind of come back into fashion, I'm going to say, this year. So far in 2025, there have been over 150 IPOs, which stands for initial public offerings. These IPOs have raised about $29 billion so far this year, and it's a nice increase in the total number of IPOs when compared to recent years. At this time last year, just 99 IPOs had occurred. And in 2023, it was even worse at 76. So we are getting this, again, IPO, I'm not going to call it a boom, but increase.
Yeah, so we're seeing a lot of those. And I mean, I think with IPOs, there's always some excitement or some optimism around them. And I mean, sometimes I would say it works out for a very small number of people, but there's just so much risk. And early on, when they finally get listed, they are so volatile in those first couple minutes even.
Yeah, I mean, if you look at just the excitement around it, kind of to your point, I mean, the first day gains are averaging 26%, which is the best since 2020, and that sounds exciting. And I mean, if you look at some of the hot ones like Circle, Figma, Bullish was another one. I mean, there's several others, but there's been some that have closed up 82 to this number blew me away. 735% on their first day from their initial offering price.
Do you know which one that was?
I'm not sure which one it was. 735. We're going to talk more about Newsmax. It was potentially Newsmax.
I know that is one that we're going to talk about.
Yeah, so we'll kind of hit the numbers on that. But I mean, there's been a few that have been, pretty jaw-dropping in terms of the gains that you see, but others have not done so well. I mean, StubHub, there was excitement around that. Its current price around $17. The IPO is $23.50. It opened around $25.35 and then peaked at $27.89. So really, since that first day on IPO, you saw a high of $27.89, now down to $17. I love this one. Gemini Space Station. That's a fun name. It's a crypto firm led by Cameron and Tyler Winklevoss. That's now around $24 a share. Its IPO is 28, opening price 37.01, and the high within minutes of trading went up to 45.89. So there's probably somebody out there that was super excited about it. They bought it at 45.89 and now have seen that cut, I'm going to say almost half.
And I mean, that's the thing to keep in mind too, because the IPO price is not the first price you can buy when it actually gets listed. So in that case, the IPO was 28, but if you were the very first person to be buying, you were buying at 37.
Yeah. Yeah, and it's something that you just get hit with, and it's like, oh my gosh. And, kind of circle back to the risk in the market. I mean, one thing that has just blown me away is, we talk about Gemini Space Station. That one hasn't worked out, but then there was this other crypto exchange called Bullish that went public. I think there was another crypto exchange that's also gone public this year. You have Coinbase, you have this crypto. Why do we have so many crypto exchanges? There's Kraken. I mean, there's so many out there, and you're like, what the heck is the purpose of having so many different crypto exchanges? I thought the benefit of cryptocurrency was to hold this thing that the government couldn't track, but
they're tracking it. Let me tell you, they are tracking that thing. You get a 1099 when you sell, you got a capital gain, report that. Yeah, they're tracking it.
Yeah, it's just something that I looked at that saying, gosh, I mean, this was it again? Gemini Space Station. I think its market cap's like over $2 billion.
Yeah, it's like $2.5 billion or something like that.
No way
Which I mean,
that.
when you look at like the Cameron and Tyler Winklevoss, they don't care at the end of the day because they created this company, or started something and put a name on it, and IPO'd, and so they get cashed out of whatever stock that they put in the IPO. So they're happy.
Yeah.
Is now they created this thing. Who knows what its actual value is, but they got, I don't know, $1 billion. So that's good for them, I
Their
guess.
net worth looks pretty nice right now. But I mean, kind of to your point too around volatility, I mean, one of the big reasons there is so volatility around the IPO market is many times these companies, they're only releasing around 15 to 20% of their equity.
Mm-hmm.
And then you also have to take into consideration there's often a initial lockup period of around 180 days. So, many of these prominent people that are in these IPOs can't even trade within the first 180 days. So this really reduces the float or the number of shares that can trade, and it really has this big distortion on what is going on with the price of that stock. That is something you have to keep in mind because it's just something I will never get involved in the IPO trading because it's such a small subset of the shares trading. You're not getting, I think, a true valuation of that company.
You're definitely not. And the investment banks that sponsor these things are trying to get as close of a price they can to what its actual value is. But initially, like you said, if only a very small portion of that is actually being traded, depending on who's buying and then who's actually buying and then trying to trade those positions, there can be so much volatility, and you win and you lose. But it's really more of a gamble.
Yeah. I mean, it's a huge gamble. It's a gambling chip at that point rather than a long-term investment in many cases. Now, if you got in at the IPO price, maybe it's a long-term investment. But if you're getting in on the first open trade, I think that is where you can. I would never do an IPO, just to be clear. But
and I wouldn't think of it as a long-term investment. I mean, anything where you lose money quickly, you could look at, oh, well, it's a long-term investment. It's all right. So
true. And I mean, the thing you have to realize too is, again, that investment bank, the reason that they need or want to, I should say, try and get the best price at that IPO level is because that is then money that the company can now actually use. If you go IPO, you raise $450 million, let's say, and now that IPO price is 24. Well, let's say if it was first trade comes out at 40, well, you left that money on the table that company could have actually utilized for the business. So that's why many times these investment banks, they need to try and get the best price possible, as that is capital that the business can try and then implement, which is to me why when something goes public and it trades way above the IPO price, it's like, why would you be buying that?
Right. Yeah, exactly. Sense. I mean, they are incentivized to get as high of a price as possible, which as a buyer of an IPO, you're like, okay, I'm already taking that high price and I'm going to buy it because I think it's going to go even higher, which the only time that really happens is if there's a lot of other people that are hopefully doing the same thing and they're buying it and pushing the price up.
Yeah, exactly. I mean, you kind of talk about pushing the price up. I said we talk about Newsmax, and this one just blew me away. It's a conservative kind of news outlet, but they went public issuing the IPO price was around $10 a share. I think it was exactly $10 a share. Mm-hmm. It very quickly went to $265. At one point, I think it was like this thing is almost worth as much as Fox News. Today, it's around $13 a share. Now, again, you got the IPO. You're still up 30%, not too bad. But there's somebody out there that paid $265 a share. And if they didn't trade it, well, actually, they definitely didn't make money since that's the all-time high. Mm-hmm. But if they're still holding it, you're sitting at a very, very substantial loss. And that's what can happen in these IPOs is they are crazy. There's so much risk involved. That's why I just recommend don't do it. The way that I think you can benefit from IPOs, look at these investment banks, right? You look at Goldman Sachs, look at JP Morgan Chase. They're the ones that are benefiting from, I'm going to say, the excitement around IPOs because then more companies go public. Mm-hmm. Now that gives them a larger kind of pool of clients. They should have nice profits, I think, at least for the next few quarters, maybe the next year or so of clients coming public. That should be nice profits for those businesses.
Yeah, that's definitely, I think, a good way of looking at it. Yeah,
you're not going to make 100% on Goldman Sachs or JP Morgan Chase.
You don't need to. Yeah. You don't need to, and that's the thing. The only time you can make 100% or make that much money is if you're taking a gamble, which means you also have the ability to lose that amount of money in that period of time.
Exactly. I mean, kind of speaking about that going public, I mean, there are some potential firms going public here within the next year. It's Wealthfront, the robo-advisor. Here's another crypto company, Grayscale Investments. I don't understand why anybody buys their Bitcoin ETF because it is way more expensive than the other ones. You also have Stripe. I've actually used them before. They're pretty good fintech. And then sports apparel and betting company Fanatics. There's also other major private companies like OpenAI and SpaceX that have obviously not gone public yet. It'll be very interesting to see if they do go public within the next, I don't think it'll be next year, but maybe next 5 years. At some point, they have plenty of private money keeping them with the ability to raise capital. But at some point, those people that are early investors want an exit.
Right.
And that's why you go public many times is to provide that exit. So again, IPO market, very interesting here. Speaking of different markets, let's jump into real estate. This is something that I'm going to say has slowed quite a bit, but we're getting more numbers here, just get them every month. But we got existing and new home sales for the month of August. And I got to say there's a stark difference between the two reports. The headline number for new home sales showed an increase of 15.4% compared to last year, while existing home sales were up just 1.8% over the time frame. So what the heck's going on here? Why was there such a big difference? That's a good question.
Yeah, I mean, new home sales increase of 15.4%, while existing home sales up 1.8%. So, I mean, that's quite a big difference. But when you look at that, first important consideration is new home sales can be extremely volatile on a month-to-month basis, and they make up a much smaller portion of overall sales. Pre-pandemic, new home sales were normally around 10% of total sales, but with the limited listings in recent years, they've been closer to about 30% of all sales.
Yeah, we've seen a huge change in again, that percentage allocation in new home sales. And, one other thing that you have to understand with the new home sales and existing home sales reports is new home sales look at people that were out shopping and signing deals in August, while existing home sales looks at closing in the month, which means these were deals that were signed in June or July. So there's actually about, I'm going to say, make it easy on me, about a month and a half lag when you're looking at existing home sales compared to new home sales. And interest rates may have had a slight impact on that, because if you look at the 30-year fixed mortgage, it was around 6.7 to 6.8 in June and July versus around 6.5 to 6.6% in August. And also, too, many times new home builders are buying down rates even further for their customers.
I think that's probably a good part of it as well. And I don't know why they do that. If I was buying a new home, I wouldn't be interested in that. I'd rather just buy the house at a lower price, because they buy a house they sell a house for $500,000, and they say, okay, well, we'll give you $10,000 toward closing to buy down the mortgage rate, to do like 2-1 buy downs. They play these little games so that you as a buyer then have a lower monthly payment, but you are the one that's paying for it anyway because you're buying the asset. They're using your own money to then give a little bit back to you so you can be happy about the payment.
Yeah, and I think you're right, because if rates do decline, I much rather would have had a lower purchase price that now I can refi into that lower rate that you offered me anyways, where now I can't do anything.
Right.
The mortgage rates are falling.
Right. So, I mean, for the same reason we've talked about right now, I don't think it makes sense to pay points to refinance a mortgage. Wait till interest rates come down. You still might want to refinance. Jason and I are actually both looking at refinancing right now. It still might make sense to refinance, but you don't want to pay extra to get a lower rate, because you might be able to refinance and again in 6 months and not have to pay for it. So, but when you buy a new home and that seller is giving you credits, you're basically locked into that. And at that point, you have to take advantage of it, I guess. Yeah. But I don't know why they do that. I'd rather they just, lower the price.
Because it still costs them money. But I bet you that it's almost that psychological benefit.
It is. It absolutely is. It's a sales tactic.
Yeah. Not say trick, but persuade them to buy with this. And that's less of a hit to gross margin than if we just lower the price. There's more perceived value.
There's more perceived value, and it makes the house look more affordable.
Yeah.
So, you increase the number of people that can afford that payment. But again, I don't like the way that they do that.
Well, one other thing, too, that may be impacting the sales pace there is the amount of supply on the market. Right now, new home sales had a 7.4-month supply in August. That was actually down from a 9-month supply in July due to the higher pace of sales that we saw last month. And this compares to a 4.6-month supply for existing homes. One thing that you have to consider is home builders. They need to move the inventory much faster than an existing homeowner. Home builders do not want to hold excess inventory because it's just going to sit on the balance sheet. It's going to go stale. They want to produce that cash flow. Where a home seller, an individual person, they're like, I don't need to sell it in many cases. They're like, I saw that, my neighbor sold it for this great price. So
they've got one house to sell as opposed to a home builder who has a ton of houses to sell. They're in the business of turning over inventory as quickly as possible. Where a home buyer, that might be the biggest asset they have, or a home seller might be the biggest asset they have. So they're more willing to wait essentially for what they think the house is worth.
And I think that's so important because I think this has made homes sit on the market for longer. I was somewhat surprised by this, but homes are now sitting on the market around 31 days on average as compared to 26 days last year. I think a lot of home sellers became unrealistic with the price they can get for the home and also, too, how quickly homes would sell. I mean, during COVID 2021, people would
sight
buy
unseen, same day. Yeah.
That is not happening now.
It shouldn't happen.
Much different. But, I mean, we're still seeing these high prices in homes, and it's interesting to kind of look at how you're having this back and forth, right? Where I don't think prices are going to go down a whole lot because people aren't going to be willing, if their house is perceived at, I'm going to say $2 million, they're not going to be like, I'll take 1.5 for it. They're just not going to sell. But on the other side of it, I don't think prices will appreciate very much because people just can't afford for prices to continue to increase. And mortgage rates are not going back down to 3%. So I don't think that can offset a huge gain in prices. I think we're just going to see this subdued real estate market as we kind of move forward in the next 5-10 years.
Slow growth.
Exactly. Well, we'll be right back here after a quick break. And when we come back we're going to talk about insurance versus investments. We still got a great show coming up, so stay with us and we'll be right back. Alrighty, welcome back to the second half of the Smart Investing Show. Full second half here. We're going to talk about insurance versus investments. And then also, too, we're going to take a closer look at 3 different stocks. We're going to look at Compass, PACCAR, and Amazon. But first up, again, we'll talk about our financial planning topic of the week. Harrison, take it away with insurance versus investments.
So they're different things for different purposes.
What?
Insurance, the fundamental purpose of insurance is to protect against loss. So life insurance, if something happens to you, there's some money to take care of your family. Health insurance, if you get sick or, get hurt, then you have health insurance. Auto insurance, if you get into an accident. It's all to give you money in case something happens. And you pay that premium. So you pay a set amount of money that you know about to protect against a potentially really large amount of unknown money in case of, something going wrong. So insurance is to protect against that. Investments are supposed to grow and ultimately give you income. So stocks, real estate, investing your money in that helps your money work for you. That might mean that there's short-term volatility, there might be some uncertainty, but long-term, good assets grow and they create income for you, and that's what the purpose. So the point is, there's insurance companies out there that try to, muddy the water here, and they sell or they push insurance products as investments that fundamentally does not work out well. So, when you look at permanent life insurance, whole life insurance, variable universal life insurance, index universal life insurance, annuities, all kinds of different annuities, those are insurance products offered by an insurance company, targeted to sell as an investment. And realistically, they just don't perform that well. They're inefficient. They have high fees. There's a lack of flexibility. There's lots of fine print. So really, they're poor substitutes for actual investments. So insurance, you're better off with using it for protection. Investments are better for building wealth. You want to keep those things distinctly separate.
Yeah, I mean, a great thing, right? I have home insurance. I have auto insurance. I have life insurance, but I have investments. I do not view them as the same thing.
Right.
They're two distinct things. Insurance to me is essentially an expense.
It's a necessary evil,
Yeah.
I would say. You have, I mean, in cases
Yeah, if something
you
were
need
to
it.
happen to me, yeah, my wife needs money to come in to take care of her and my 2 daughters, right?
Mhm.
I need life insurance, but I don't need life insurance forever.
We also don't need to pay thousands of dollars a month for it either.
I think mine's like $50 a month
Yeah.
is my life insurance.
Yeah. For
now.
term life. And it's like
For a $2 million
for it's
policy.
$2 million. Yeah.
Yeah.
So it's plenty of cash for $50.
Yeah.
If that was a whole life policy, I don't even know. It'd be literally thousands of dollars a month. Universal life would be, if you were trying to do it right, would probably be thousands of dollars a month for a $2 million death benefit. That's a really large amount for any type of permanent life insurance. But I mean, we see so often people come in and they have insurance. Again, some insurance is necessary, but in the purpose of permanent life insurance, we see people that come in with annuities. Very few people understand really how they work, or even
You get a huge binder basically with these products.
yeah. And again, that was not written in English that you or anybody else can understand. It's written by attorneys. But I mean, I have one person in my time of doing this as a, financial CFP, everything. I've had one person who had purchased whole life insurance, or was it whole life insurance? Anyway, it was a type of permanent life insurance, cash value building life insurance that actually I was like, oh, this actually did pretty well. I'm surprised because usually the returns aren't that good in these types of things. If anybody says otherwise, I would love anybody who's out there that's like, oh yeah, my guy's really good. Or if you're somebody who sells this stuff, I would love to see the actual numbers.
Not the illustration.
Not the illustration. Yeah. Oh, I put this money into it and it actually returned this well. I would love to see it because the one time I found somebody who bought some permanent life insurance that actually performed well, when they got to the point where they were trying to extract some of the cash value, they couldn't because the company was going through a restructuring or a bankruptcy or something. So to this day, that money is still tied up and they don't have it. So the one time I found it where it might have actually worked, didn't actually work, and they still can't get their money out of it.
Yeah. And that is one thing that we've talked about in the past where the insurance, the way that it's written, the annuities, they might have guarantees built in there. And for those listening, I did the air quotes on guarantees because it's not guaranteed by the federal government. Some people might say, oh, that's not a good guarantee anyways. Well, actually, that is a pretty good guarantee. The federal government is going to be, I think, the best place to get a guarantee because
technically it is. Technically, if you look
power.
at like tax-free rate and everything, or the risk-free rate.
Yeah.
Yeah, federal government.
The only people guaranteeing that product is the company. If that company goes bankrupt, which is a possibility, especially the ones that generally pay the best bonuses, that pay and offer the best rates, offer the best guarantees, they're smaller insurance companies. Your big insurance companies like a Nationwide or John Hancock many times don't have as good of bonuses and the alluring
or like
products.
Northwestern is a big one,
Yeah.
or like MetLife used to be a big one, Mass Mutual, New York Life. Those are like the really big ones. And
So those smaller ones, they run that risk of bankruptcy and maybe you not being able to access your money.
And
not worth it. And then your big ones, they don't offer very good rates.
And to me, that's not even the biggest thing, because if you buy an insurance product, chances are that company's not going to go bankrupt. This is, my case. I finally found one that
Worked.
appeared like it worked, and it actually didn't because the company, couldn't handle it. But in the bigger reason of why you want to stay away from those as an investment is because they just don't perform well. If they did, I would sell them. I would love to make a large commission on something that I actually believed in that would help somebody. But they just don't. So, we had somebody else come in here. This lady is 77 years old, bought an annuity 10 years ago, and it's made no money. So you haven't lost any money. Congratulations. You've made no money in the last 10 years. Well, pretty much everything you could have bought and has gone up over the last 10-year period. And the problem with this specific thing is a lot of annuities that are sold these days almost have like two separate accounts in them. There's the actual money, and then there's these riders or these income bases is what they're called. And that income base is just, it's not an actual number.
Funny money.
It's funny money. It's something that the insurance company uses to base what your payout is going to be if you decide to annuitize and take income from it. So these income bases or these guaranteed withdrawal amounts or whatever, they're the ones that have all of these guarantees. You know, like it grows at a guaranteed 8% a year. You get these bonuses. All these guarantees that actually sound pretty good is only tied to that one specific type. But you cannot surrender that annuity or withdraw from that amount. All you can do in most cases is use that as a basis for calculating what income you're going to get. So in other words, you might have an account where the actual money in there is $100,000, but the income base is $200,000. And if you decide to annuitize, meaning take out a percentage for the rest of your life guaranteed, it's based on that $200,000 number. And, you know, maybe you could take out 5% for the rest of your life based on $200,000. Or if you want to surrender the policy or surrender the annuity and take your money, you only get that $100,000. So it's a way to lock you in to
Forever.
where you can't leave. And then the problem, you know, for somebody who's 77, if they do take the 5% from the $200,000, I'm just making up numbers here to kind of illustrate the point. If you're 77 and you only can take 5% of that $200,000 number, you have to live 20 years to break even on that $200,000. She's 77.
Yeah.
Is she going to live to be 97? Maybe.
Yeah.
Maybe. So that's what I mean. I mean, these things, they are just, I said earlier in the show, I hate them. I hate them so much because unsuspecting people trust financial advisors who, you know, they think they can go to their fiduciaries, great CFPs. I'm a CFP. I don't agree with most CFPs. There's plenty of advisors out there that sell these things and they're just terrible. They're just terrible every single time.
No, I mean, I totally agree. And it's, as you said, you didn't lose money in many cases, but just the opportunity costs that are.
You know what else doesn't lose money? A checking account. It's not a good investment.
Yeah. Yeah. No, I agree with that. I mean, I think I've made this argument
gets
before.
me all riled up.
I'd much rather buy a 10-year treasury over an annuity.
Yeah, especially right now. There was a time when treasuries were, you know, not paying anything, but in the current market, I can't think of a situation where you would buy an annuity over a treasury.
Well,
I wouldn't really do either of those things for
No.
long-term money.
No, absolutely not.
Well, that's the other thing that's so paradoxical about it is because when you buy annuity, they all have surrender charges. You know, 5, 7, 10, 16 years I've seen. So they're all long-term investments, but they also are guaranteed to not grow that well, no matter how it's structured. Oh, it has participation rate, has cap rates, has all this stuff that is just doesn't mean anything. It's not going to grow. It's not going to perform well. It might have all of that stuff, but gosh, where I don't even know. I was just so riled up. I forgot what my point was.
But I mean, the thing that you look at is it's not. It's a long-term investment.
That's what it was.
Terrible long-term investment.
and the reason why you like T-bills or you like cash is because it's liquid. Yeah, it's guaranteed. Yeah, it's not going to make a lot of money, but that's not the point of it. The point of it is to be liquid. With an annuity, you're not going to make a lot of money, but it's also not liquid and it's not going to grow a lot. So that's the paradox of you lock your money up for a long period of time that's you can't really access that well, and it's not going to grow.
And the problem is, kind of circle back to this whole income riders, the product that we spoke about with the woman that was 77 years old. The reason that money doesn't grow, the actual money that you could potentially access, is because these income riders are so expensive. So you're growing that income base with the guarantees, but your actual surrender value,
actual money in there,
is not growing because all the fees in there are getting eaten up within it. And it just, if you change your mind 5-10 years down the road, as she did, and said, well, my advisor's not getting back to me. Well, they're not an advisor. They were a broker. They sold you a product. They make no money. They have no way to make money off of you now.
Afterwards, yeah.
After the fact. So they're not taking care of you. I want to change course and hire you an advisor. We said we can't because your income base is too high. You don't have beneficiaries. You're going to just need to annuitize this product because there's no way that I could, in good conscience, tell you to take half of that money essentially when you need income, and I can't provide that to you. It was just mind blowing to
and
me.
That's what gets me so upset about it is you literally have this old lady, 77 years old, needs income, doesn't understand how this works or what she agreed to, and this is really her only option at that point. And again, we didn't charge for this. We didn't, if we were scumbags, we could say, oh yeah, we'll take this money out and we'll go do something else and, try to make money off her. We did not do that. We said, based on what you have, this is the really only option.
We helped her annuitize the annuity.
So yeah, we went through the annuitization process. Yeah, great job, advisor. Sold her something and then threw her out on the street. Jeez.
Well, obviously we are not fans of annuities, and again, take Harrison up if you think you got.
I would love to see it. I would love
annuity.
to see it because even people were like, "Oh, well, I found a good one." No, you haven't. You just don't understand how it works. And if you're an advisor who thinks you have a good one, no, you don't.
Yeah. So again, take him up on it. If you think you have a good one, send it to him. He'll take a look at it.
I would love to.
But let's take a look at some stocks here. Again, that's our bread and butter. That's what we like to look for is good value investments. Again, it's hard to find good investments right now with everything being overpriced. There are still some out there, but it just seems like show after show is like, gosh, that one's not good. That one's not good. But let's see if we got one today. First one we're going to look at today is a company by the name of Compass. They are the brokerage giant in the real estate space. They just announced plans to take over rival Anywhere, and you might not recognize the name Anywhere, but is the parent of Century 21 and Coldwell Banker for $1.6 billion in an all-stock transaction. So Compass, I mean, I've seen the CEO on before. He seems to be pretty knowledgeable. I like what he has to say. But the one thing that worries me about this space, I would say, is, the competition from the likes of, like a Rocket Mortgage. I just think people shifting towards that tech space and bring up Rocket Mortgage because they bought Redfin. Are they going to be able to digitize more of the real estate transaction? And that's not going to be for everybody, but it's still a growing base. Might be enough to eat into profits for a company like a Compass, which is why you might be seeing this type of consolidation. But looking at the numbers here for Compass, their ticker symbol is COMP. No price to earnings, so not a good start there. Price to sales, 0.7. That's appealing considering the industry average is 2. Price to cash flow, 25.9. So that's substantially above the industry average of 15.2. Looking at earnings growth, nothing there as there were no earnings. Sales growth over the last year, though, up 21.2%. Obviously, we had seen a very challenging real estate market, so maybe they will benefit just from increased transactions. Obviously, that could be a benefit to Compass as a business. No dividend. Balance sheet doesn't look bad. Current ratio is 0.7. Debt to equity, 0.8. Looking at the current price, though, $7.95. 52-week low is $5.10, and the 52-week high here, $10.25. Now, if we go forward for Compass, I believe they do report on a calendar year, so we go out to December 2026. I see estimated earnings per share is 17 cents. Gives a target sell price of just $2.82. So, I think this is one that you could see some growth in the earnings and growth in the sales. I mean, if you look at the earnings estimates, just kind of going out a few years here, earnings are estimated to be negative this year. Then you see that flip to 17 cents, as I mentioned, and in the following year, 33 cents. So the hope is, this company could profit off of a return to maybe normalcy in the real estate market and just kind of higher transaction volume.
Yeah, I mean, is part of that, with acquiring Century 21 and Coldwell Banker and with the purchase of Anywhere, that's an interesting name.
I know.
But, I mean, it seems like, they kind of got to get the synergy lined up and be a bigger brokerage and, hopefully get their costs a little bit under control, and then, that can increase their margins and work out for them. But it'll be interesting to see what happens with, the real estate transaction space over the next 10 years, I'll say. Same with like mortgages and the financing of houses. With so much tech-enabled stuff going on, I mean, is selling a house worth 6%? Worth 5%? I mean, that's the only... when you break that down and compare to like mutual funds used to have loads where you would, have a fee to buy them. Yep. But with the, advancement of technology, different people are able to buy things quicker. And so a lot of those costs have gone down. So I wonder if that's, something that we'll see with the brokerage space on real estate as well. That's
the exact example I was thinking with the advancement of like ETFs, right? Mm-hmm. That has had to cost a lot of these mutual funds management fees because they've had to lower their fees to compete against it. Now, real estate, I don't think has really gone through anything like that. And I could be totally wrong, but I think
that's where, was it last year where, because usually, you sell a house, you have the commission, and then that commission pays the buyer and the selling agent fee. And now with that whole thing last year about trying to unwind that. So, we're starting to see some of that, and I could see things like that continuing to go forward. Maybe that is helpful or not in the grand scheme of things, because if you don't have somebody who's really representing you as a buyer, you're buying a huge asset, it might be worth 2% or so to get that representation. But so many people are fee conscious where they might be willing to give up some of that representation for a lower cost.
Yeah, no, it's going to be interesting. And I don't know how, if you're looking at this space, right, you're going to want to understand those intricacies, because a company like Compass, now their market cap's around $4.4 billion. They're buying now anywhere for $1.6 billion. If this space slows and this transaction comes out to be a bad deal, obviously, you don't want to be a part of that. You could have just wasted $1.6 billion on this transaction. When, again, a company like, I'm going to use Rocket as an example, again, when they're buying Redfin, they're taking a totally different approach. They're saying, I think we can implement more tech advancement.
Right.
And again, I don't know Compass's business inside and out, but I think they're leaning more into the human capital element. So that is something that I think you're going to have to take into consideration. I definitely don't think I'd buy Compass at these levels. I thought maybe there'd be some potential there on the value side, but gosh, yeah, valuations still look pricey on Compass, to say the least. Next stock, let's take a look at here is PACCAR. Now, PACCAR, you may not recognize that name, but they are the big truck maker. They make Kenworth and Peterbilt trucks, and this is one we actually held in the portfolio years ago. I loved this company. I thought it was a great business to hold, and just very, I'm going to say, well respected by most in the industry. The reason they're interesting here is shares had a nice pop on Friday. Looks like they're up about 5%. President Trump did announce that he will impose a 25% tariff on imported heavy trucks. He did say in the post that large truck company manufacturers such as Peterbilt, Kenworth, Freightliner, Mack Trucks, and others will be protected from the onslaught of outside interruptions. So the reason this could be beneficial for PACCAR, obviously, is less competition coming in and trying to undercut the prices. So it gives them potentially more protection around their margins, let's say, being that U.S. business.
Yeah, great business. Been around for a really long time. Started in 1905 making rail cars, kind of pivoted after World War II. Now, if you look at truckers with those brands, Peterbilt, that's one that's very common. That you see
them on the road all the time.
Yeah.
I'd say you see those. You see the Mack trucks as well, but if you actually look at a lot of trucks, when we held it, I always look and I'm like, oh, most of them that you see are Kenworth or Peterbilt, I feel like.
Before, when I was studying for the CFP, I worked at this little financing company, and we were repossessing all of these trucks out in North Dakota, and they were all like truckers, and they were all PACCAR cars. I did that for a few months.
This was about 11 years ago, 10 years.
Yeah, about a little over 10 years ago.
Got to start somewhere.
I was an accounts receivable manager, calling people, and they do things differently in North Dakota. I'll say that.
Well, let's take the numbers here for PACCAR. The price to earnings for the business, 17.2. That is below the industry average of 20. Price to sales, 1.7. Industry average here, 1.4. Price to tangible book value, 2.8. That is favorable compared to the industry average of 12.3. And price to cash flow at 11.8. Also looks good against the industry average of 12.4. Looks like the company did run into a little bit of a hurdle in terms of earnings per share. It was down about 38% compared to last year. I'd be curious as to what happened. Their sales did decline 11%. So much has been a slow industry for truck sales over the last year. And many times if you have a high fixed expenses, it can really accentuate the downturns in earnings per share. But again, a 38% decline, I'd want to have a better understanding of what the heck happened there. Dividends, 1.3%. The interesting thing I remember about this company, though, is they pay an annual special dividend. So I believe that forward yield of 1.3 is based off the quarterly payment, not the annual payment as a part of that. So dividend yield could be even more attractive, maybe around 2-3%, depending on how big that annual dividend payment is. Balance sheet's always a little bit weird with PACCAR. Current ratio is 3, debt to equity is 0.8. They do financing on a lot of their trucks, so it could distort how that balance sheet actually looks. The actual debt for the business, as I remember from years ago, was actually very, very solid. So if things haven't changed, the balance sheet was very clean for PACCAR a few years ago. Look at the current price for the business. Their ticker symbol, again, PCAR, $100.50. 52-week low here, $84.65, and the high, $118.81. I'm going to say going forward, this company, it looks okay. Go out to December 2026, estimated earnings per share, $6.29. Gives us a target sell price of $126.16. That forward PE multiple is around 15 and a half. So that doesn't give us quite our 30% margin of safety on it.
It's about fairly valued, I'd say.
It's about fairly valued. We still got about, I'll call it 15, 20% growth on that stock. So it would be in our hold category. If we got a pullback on this business, though, I definitely think it'd be one worth evaluating. I think it's a good business, especially if you can pick it up at a good valuation.
Yeah, I mean, in April, it got down to the 80s. So that potentially would have been an opportunity. But, I mean, earlier in the year, it was up 112 and then went down to 88 in April when everything went down, and then since then it's kind of just been chugging along up back to 100 now.
Yeah, so I mean, this one, as I said, I'd bottom line, I'd give it a hold rating if I was a stock analyst.
Which you are.
The Wall Street guys that say buy, sell, or hold, I'd give it a hold. Well, final company let's take a look at here is Amazon. And as I mentioned, the kind of early part of the show is Amazon did agree to pay a $2.5 billion settlement to the FTC for allegations that the company duped users into paying for Prime memberships. And I just got to say, this just irked me. I'm like,
duped you.
I mean,
were you duped? Is that why it irked you?
I have an Amazon Prime membership. I knew exactly I was signing up for an Amazon Prime membership. I don't know how you get duped into one of those. Like, I will agree with the fact that sometimes these subscriptions are more challenging to cancel than they should be. And I think that is one thing that we should learn is that should be changed to make it easier to get out if you want to cancel. But when you sign up for these in many cases, I just can't believe that.
Well, that's, I mean, when you
the amount
buy
of duping was worth $2.5 billion.
Well, of that $2.5 billion, $1 billion was a civil penalty, so that's to the government, and then the other $1.5 billion is earmarked for the refunds to Prime customers.
You ready for this? Amazon will give $51 to eligible customers. So again, this is not necessarily going to be a great win for you if you did get duped into an Amazon Prime membership. Well, that covers like 4 months of your Prime fees, plus or minus.
Yep, yeah.
And I think the big reason Amazon ended up settling was, this blew me away. There was a couple members of its executive team that could have been held personally liable in this case. And I was like, oh my gosh. So I think they were like, we don't want to risk taking this to a jury and having them lose money. And then also, potentially the fee could have been even higher if it did go to a jury. And
I'm sure it would have been way higher.
Oh, absolutely.
If it went to a jury.
So anyways, we kind of look at that just as a fun story behind Amazon. Haven't looked at Amazon stock in a while. I know it's kind of languished compared to a lot of the Mag 7. Just kind of jumping down here. The year-to-date return's actually about flat, just a 0.2% return. 1 year return's only 14.2%. This kind of, again, comes back down to how numbers work. The 3-year return, though, is 93.2%. If you would have bought after that huge upswing, you really haven't made much money since then. 5-year return, though, is actually not that great either, 45.6%. But looking at the valuations for Amazon, I was thinking maybe if things slow down, maybe those earnings would finally catch up, but that's not the case. Ticker symbol again for AMZN. But price to earnings 33.5, above the industry average at 31.8. Price to sales 3.5, industry average 2.8. Price to tangible book value 7.6. Industry average 48.5. Maybe there's a lot of consolidation and goodwill in the industry. But price to cash flow at 19.6, also high at 8 compared to the industry average at 18.9. Amazon's 19.6 again. You're getting decent growth here. Earnings growth over the last 1 year up 56.6%. Sales growth up 10.9%. We know a lot of people are shopping online that continue to benefit from that. I mean, I know I do. I spend most of my money on home supplies and everything at Amazon. It's just so easy now. But looking at the balance sheet, good balance sheet for Amazon here. Current ratio 1, debt to equity just 0.4. Looking at the 52-week range here, the low is $161.38, the high $242.52, and the current price $219.78. As I said, it's been essentially flat on the year. But going forward, we got to December 2026. I see estimated earnings per share here, $7.60. Gives us a target sell of 126.16. Trades at a forward PE still of close to 29 times. So Amazon still pricey. Definitely would rate it a hold based off the valuation. Well, thank you again for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you would like to discuss in more detail your investment needs or your other investment questions, feel free to give myself, Chase Wilsey, a call, or Brent Wilsey as well, at 858-224-0004. You can also reach our financial planner, Harrison, there as well. Be sure to visit our website, smartinvesting2000.com. You can sign up for our newsletter and see other news segments that we've done there in the past. Thanks again for listening. We have more information for you, and we'll be right back next week.